Consumer price index crossing right now and coming in more benign than estimated, 0.3%. The headline increase in September inflation on the consumer level month over month. Core coming in with an increase of just 0.2%. Both of those numbers 0.1% better than had been anticipated. The year over year figures on both core and headline both coming in at 3%. So again here, 0.3% the month over month gain in September in inflation. And recall, of course, that this is a delayed report. Remember, with the government shutdown, initially we were supposed to get this report not about 10 days ago. And so it was pushed back until now. And so this report really getting more weight as well, because we're not getting other data from the government. So again, this report coming in and showing inflation is not reaccelerating. In fact, it is decelerating right now. So the really not putting to rest, but at least pushing off some of the concerns about tariffs and the effect that they might have on inflation. So we continue to watch the markets. We are seeing an uptick in futures. Right now, the Dow futures indicating a gain of 1% at the open, the S&P futures 0.75%, and the Dow up about 0.5%. So at first blush here, these numbers looking pretty good. For more on the September Consumer Price Index report, let's bring in our roundtable of experts. Joining me now, John Hilsenrath, StoneX Senior Advisor and Yahoo Finance contributor, here with me on set, Joe Brusuelas, RSM Chief Economist, and George Bory, Allspring Global Investments Chief Investment Strategist for Fixed Income. Joe, I'm going to start with you. I had your estimates right in front of me going into this, and they were in line with the consensus estimate. So these numbers coming in better than anticipated.
Right. We're going to get that Fed cut everybody's expecting, I think, is the major takeaway from the first glance at the housing data, or excuse me, the inflation data. As I'm taking a look at it here, housing, shelter, and food all increased at a little bit slower pace than what we had penciled in. So it's looking a little bit better. That will help across the yield complex this morning. But we make no mistake about it. We're still seeing services advance at a 3.6% year over year basis, food at a 3% year over year basis. And even transportation, which was down, is just stuck at 1.7%. But it's looking better than what we initially expected. That's a market positive story this morning. And my sense is, though, as we go forward, remember, this is likely to be the last solid quality report we get until probably early next spring because of the government shutdown. So these BLS is going to be imputing or rather guessing at a lot of the estimates that they're making.
September CPI just printed cooler than expected. Headline up 0.3%, core up 0.2%, and both year over year at 3%. Futures are ripping, yields dipping, and the cut next week narrative just got fuel. But don't blink. Beneath the surface, services inflation is sticky and tariffs are quietly distorting prices. Let me show you what everyone's missing. Let's take a quick look at the report from Yahoo Finance.
John, I know that you have also been concerned about inflation. Does this report put any of those concerns to rest? It doesn't sound like they do for Joe.
It doesn't put them to rest, but listen, these are good numbers. And let's talk for a second about what it means for the Fed, because the Fed has been of the view that inflation is going to recede, and it has the leeway to proceed with cutting interest rates. And what this report means on the face of it is we're sure to get a rate cut next week, a quarter-point rate cut. And then the market's immediate response to this is going to be that there's likely to be another rate cut in December. So this is very bullish news. I personally think that there's going to be some inertia and persistence in these inflation numbers going forward. As Joe just mentioned, we're not going to have quality data. But let's take this report for what it is on the surface before we, start reading the entrails. This is better than consensus, and the Fed will feel comforted by this.
And George, we're seeing bond yields tick down already in responses. They were already sub 4%. They're going even lower. Do you think that this is the market saying, yeah, we're going to get 2 more cuts this year? And do you think it's premature to make that kind of conclusion?
Yeah, as the other guests have mentioned, obviously the number's better than expected, but still well above the Fed's target. So we can take some comfort in the notion that inflation is perhaps decelerating, but it is a little premature to signal the all clear. Bond market seems to like it. It looks like bond yields have ticked down a little bit. We're now sub 4% again. We'll probably be stuck here for a little while. The 10-year's been stuck in a range for quite some time, and we're likely to stay well within that range kind of going forward. But as expected, as mentioned, it does provide cover for the Fed to continue down this path of really like a mid-cycle adjustment to recalibrate Fed policy to be more in line with both the inflation data and the growth data, and it gives them room to cut next week. That's clear. The market has nearly 100% probability of a cut priced in. December looks likely. Beyond that, remains to be seen. As Joe mentioned, the data is going to be squirrely at best over the next couple of months, and inflation is still sticky, and it's kind of stuck. Actually, it's stuck around 3%. So the Fed has some work to do if it truly wants to get to the 2% target. They don't seem to be too concerned about that at this moment in time, but that may start to become problematic as we get into next year.
Okay, here's the real takeaway. Yes, the headline cooled, and yes, this gives the Fed cover for a quarter-point cut in October, and maybe December. But that's not the end of the story. Services are still running hot, around 3.6% year over year, food at approximately 3%, and specific pockets, like beef, are up double digits thanks to supply constraints. Energy is choppy, and tariff-exposed categories, furnishings, apparel, even electronics, are showing price pressure. Meanwhile, the 10-year sliding under 4% screams slower growth ahead, even as risk assets celebrate. Add the shutdown-driven data gaps, and the Fed is effectively steering with a fogged windshield. Markets price more cuts, but the Fed's last guidance was only 2 this year and maybe 1 next. Translation, volatility. For portfolios, the smart money is taking the income the curve gives, diversifying duration, and staying selective on credit, because easy conditions can mask building cracks. This is the Cryptagon. Stay sharp, stay informed.